If you look at historical measures, all-time highs in terms of price to earnings, price to cash flow, price to sales. And so when things are stretched, when valuations are stretched, obviously anything goes wrong and price to perfection doesn't occur and markets go down. So we are in an everything bubble that was still being driven by all the free money that the Fed printed, really since '08 in two different spurts. And so, what's next? I don't know, but it has a feel like '87, which I was around for, 2000, summer to March of 2000, 2008, September 2008, and also March of 2020 when COVID came in. I think the S&P right now is down about 18% from its all-time high. And so in the COVID example, I think it was down 31 or 2% when Powell went crazy and printed money and turned on the spigots. So we got a little ways to go till we get to there. Maybe he'll hold on longer this time. Maybe he'll have to go down more. It does, interestingly, it does kind of remind me of 87 because 87 was a similar situation where it just trailed off. I guess he made the announcement on Thursday. Or did he make the announcement on Wednesday, I guess? I think he did.
Thursday was the press conference, yeah, where the market thought he was giving good news, and then he gave the full scope of the tariffs, and then it tanked.
But I think that might have been Wednesday because we had two big down days. We had Thursday down hard, and we had Friday down hard. So in any case, selling off hard into a weekend and closing more or less on the lows, that's not a good sign. And so now over the weekend we get to see if there are any bodies that are floating to the surface. We get all the people looking at their accounts, maybe calling the broker next week and saying, get me out, all that usual stuff. So, it's probably a coin toss, but there's a chance that this continues next week. And, we're down 18%. Say we go down another 10, 20%. Well, pretty soon we're going to be right where we were in COVID, and it's going to be a full-blown crisis. And so, we know what that leads to. That leads to the big print.
Yeah.
That's the point of the book. But none of us know. It all depends. The other thing they could do is Powell could come out, and I don't think he's likely to do this because he's got too much ego and he's trying to be a tough guy, but he could come out and say some nice things on Monday that, in order to try and soften it up. He's a little bit of a damned if you do, damned if you don't point of view. If he does that, they're going to think, the guy knows it's worse than we thought and he's crumping, or if he doesn't, he's whistling past the graveyard and everyone's going to say, hey, you don't get it, dude, and the market's going to keep going down. So it'll be interesting to see.
Well, obviously, the title of your book's The Big Print. You mentioned it in your comments. A lot of people don't realize when trillions of dollars is injected into the financial system, that's still trickling in. A lot of people think they printed money in COVID. One example is a lot of the pension bailout money that Biden approved is still being dispersed on a regular basis. For us, the workers and the wage earners, we don't understand finance that well. It often seems like there's plugging holes and avoiding one crisis by shifting liquidity and somewhere else to pull money out and cover hedges. What do you see as some of the vulnerabilities right now in, the macroeconomic system and global finance where things could go wrong if whatever they're trying to do doesn't work out?
Well, basically, the financial markets are a confidence game, and the financial markets react to, the policies that are being pursued. And I think the policies that Trump are pursuing are worth pursuing, and he has to pursue them. But the fact of the matter is that, in an overvalued stock market, you do these things and things are going to break. And in some sense, what Trump and Bissett did, did serve their purpose in a short-term sense. The yield on the 10-year bond, was in the 4.3, 4.4 area not long ago, and this brought it down to 3.9, 3.97 or something. So, it's kind of an evil plan. But if we're going to croak the stock market to help the bond market, and by the way, the bond market is what they say they're concerned about, and they should be, because they have to roll over $7 to $9 trillion worth of bonds in the next 12 months. So. It's a tricky situation that they're faced with.
And the bonds, that was from what Yellen did, right? To cover that, didn't she use short-term bonds or short-term notes to cover that?
Right. So Yellen really, that's the other thing I should say. Whatever happens here, some of it they may try and blame Trump for, but Yellen and Biden handed Trump and Bissett just a total pile of shit. They didn't term out the debt when the rates were low. They've got all the financing very, very short term. As short-term rates went up, of course, that's what added to the deficit of the U.S. federal government's now paying $1.3 trillion in interest cost. And, and then the excess, they put it into the reverse repo because she paid enough rates there to prevent it from going into the economy and creating direct inflation. but they've been using the reverse repo to fund all the debt purchases, and now the reverse repo is down to a very modest number. So, it's all come to a head. It's kind of the bottom line, and this is the problem with a system run by 12 people sitting around a table trying to figure out what the right rate of money is. They just can't do it. I mean, I don't care if they're godlike, they could not do it. The market does a better job. The market sets prices the best. I mean, we all know that. And so when you let prices get set by a committee, you have these extremes, and everything will look perfectly fine until suddenly it's not. You asked about vulnerabilities. I'll tell you one that was highlighted by James Lavish very well in his Informations, which is free last weekend. The U.S. hedge funds and banks have been engaged in something called the basis trade, which is where they buy treasuries and sell treasury futures, and they clip the difference between the two things, and that's good for the government, or from a treasury point of view, because what it does, it helps the government sell its debt, and these hedge funds and banks are doing it, and they lever it up greatly. The spread is very small. But if you do it 50 times over with leverage, well, the returns actually get to be pretty good. But that's all assuming that the markets are stable and continuous. And what we're seeing is, as so many times in the past, the markets are not always stable and continuous. And what happens is occasionally you get a disruption, and then somebody blows up. So it's entirely possible, in my mind, given what's going on in the last couple of days, that there's some dead bodies out there that Citadel or somebody else is in trouble. And the role of the Fed, the Fed has a dual mandate, which is protect inflation and employment. But there's a third unwritten mandate that nobody ever talks about, but everyone knows they have it, which is keep the markets functioning.
Yeah.
and the tool that they use when the unwritten mandate becomes important, as it did in 2008, or as it was in 2020, or kind of as it was in long-term capital in 1998, they print money, lots of it. And so, we go along, Powell trying to act like Volcker, saying he's getting inflation under control and he's not printing money anymore until something breaks, and then, they have to print gobs of money, right? And that's kind of what's going on.